Hello and welcome to Calmvestor podcast. I am Ethan. Join me on this journey to build solid financial thinking and take control of your financial future. Today we are diving into a fascinating and crucial topic, the illusion of validity in financial predictions. We all encounter predictions about the market, about specific stocks, or about the economy. But how reliable are they, really? Think back to major financial events like the 2008 crisis or the dot-com bubble. Many experts, with all their charts and models, failed to see them coming. It is a humbling reminder that even the most seasoned professionals can get it spectacularly wrong. In fact, studies have shown that the accuracy rate of financial forecasts made by experts is often much lower than people imagine. It is often not much better than chance. As Anthony Robbins said, market forecasters can be very smart and articulate, but they often get it wrong again and again. Have you ever felt absolutely certain about a financial decision, only to see it turn out differently than you expected? Perhaps you were sure a stock would soar, or that a particular investment was a guaranteed win. If so, you might have encountered what Nobel laureate Daniel Kahneman calls the illusion of validity. It is a cognitive bias that can significantly impact our financial well-being, and understanding it is the first step to making better decisions. So what exactly is the illusion of validity? It refers to our tendency to believe in the accuracy of our judgments, especially when they are based on a coherent story or a seemingly consistent set of data, even if that data is limited or not entirely reliable. This is closely linked to overconfidence bias, where we overestimate our own abilities, knowledge, or the precision of our information. We feel more certain than we have a right to be. Daniel Kahneman, in his work, talks about two systems of thinking. System 1 is fast, intuitive, and emotional. System 2 is slower, more deliberate, and logical. Guess which system often leads us into the trap of overconfidence? You got it, System 1. The illusion of validity often arises because our intuitive System 1 thinking jumps to conclusions based on readily available information, creating a compelling narrative that System 2 fails to adequately challenge. This makes us believe we are better at predicting the future than we actually are. We might see a pattern, connect a few dots, and suddenly feel like we have cracked the code to the market's next move. As Kahneman might put it, we often develop strong confidence in our judgments, even when the evidence supporting them is weak. This mismatch between our confidence and the actual accuracy is the core of the illusion of validity. The consequences of falling prey to this illusion in our financial lives can be severe. One of the most direct impacts is making poor investment decisions based on subjective, overly confident predictions, which can lead to significant financial losses. Imagine an investor who reads a few positive articles about a tech startup. They become convinced it is the next big thing, pouring a large sum into it, ignoring warning signs or the lack of a proven track record, only to see the investment falter. Conversely, this illusion can also cause us to miss out on excellent opportunities. If we are overly confident in a negative prediction that lacks solid grounding, we might avoid sound investments that could have brought substantial returns. Another common pitfall is overtrading, believing we can accurately time the market, knowing exactly when to buy low and sell high, often leads to frequent buying and selling, racking up transaction costs, and often underperforming a simpler strategy. Warren Buffett wisely noted that investors often project what they have just seen in the present onto the future, and this is a hard habit to break. This projection often fuels the illusion that current trends will continue indefinitely. Furthermore, when our predictions, made with such confidence, turn out to be wrong, the illusion of validity can make it hard to admit our mistakes. We might double down or look for excuses rather than adjusting our strategy. The rise of social media has also amplified this issue. We see many self-proclaimed experts sharing their infallible predictions, which can reinforce the illusion of validity in their followers, creating a dangerous echo chamber. So what are the root causes that make us susceptible to this illusion? Several psychological biases are at play, working together to cement our overconfidence in our financial forecasts. First, there's confirmation bias. This is our tendency to seek out, interpret, favor, and recall information that confirms or supports our pre-existing beliefs or hypotheses. We filter out contradictory evidence. Then there is hindsight bias, also known as the "I knew it all along" phenomenon. After an event has occurred, we tend to see it as having been predictable, even if there was little or no objective basis for predicting it. The illusion of control also plays a part. This is the tendency for people to overestimate their ability to control events. In finance, this might manifest as believing we can control investment outcomes through skill, even in highly unpredictable markets. We also have the Dunning-Kruger effect. This is a cognitive bias whereby people with low ability at a task overestimate their ability. In finance, novices might feel overly confident in their predictions, simply because they don't know what they don't know. The availability heuristic is another culprit. We tend to overestimate the likelihood of events that are easily recalled in memory, often because they are recent or vivid. A few lucky guesses can make us feel like prediction experts. Finally, social pressure and herd mentality contribute. The fear of missing out, FOMO, or the belief that the crowd must be right, can lead us to adopt widely held predictions without critical evaluation, reinforcing our own illusion of their validity. Howard Marks, a renowned investor, put it starkly: if you cannot predict the future, it is important to admit it. If you still try to predict, despite the truth, that is financial suicide. This highlights the danger of these biases. Now for the good news. While the illusion of validity is a powerful psychological trap, we can develop strategies to recognize and mitigate its impact. Let us explore some practical approaches. First, build a systematic, evidence-based decision-making process. This means not relying solely on gut feelings or simple narratives. Create a checklist of factors to consider before making any significant financial decision. Actively seek out and rigorously consider information that challenges your assumptions. Ray Dalio, founder of Bridgewater Associates, emphasizes the importance of welcoming opposing viewpoints to stress test ideas. Keep a decision journal. Write down why you are making a particular financial decision, what you expect to happen, and what your confidence level is. Then, review these entries later to see what you got right, what you got wrong, and why. Second, focus on what you can control and embrace diversification. Accept the fundamental truth that no one can consistently and accurately predict market movements. It is a liberating realization. As Anthony Robbins advises, focus on what you can control, not on what you cannot. You cannot control market returns, but you can control your savings rate, your investment strategy, your costs, and your behavior. Build a diversified portfolio. Diversification is an explicit admission that you do not know which specific investment will perform best. By spreading your investments, you reduce the risk of any single prediction error causing major damage. Rebalance your portfolio periodically. This disciplined approach helps you buy low and sell high systematically, rather than trying to time the market based on fleeting predictions or emotions. Third, cultivate critical thinking and intellectual humility. This means constantly questioning your own beliefs and acknowledging the limits of your knowledge. Be skeptical of your own certainty. Always ask yourself, what if I am wrong? Or what crucial information might I be overlooking? This type of zero-based thinking, as Brian Tracy calls it, can help uncover hidden biases and flawed assumptions. Learn from your mistakes and the mistakes of others. Every financial decision, especially those that do not go as planned, is a learning opportunity. Do not let ego prevent you from extracting valuable lessons. Understand that admitting I don't know is not a weakness, but a strength. Anthony Robbins pointed out that by admitting to yourself that you do not have a special edge in predicting markets, you are actually giving yourself a huge advantage over those who are overconfident. Benjamin Graham, the father of value investing, taught that successful investing is about managing risk, not necessarily avoiding it entirely. Recognizing and managing psychological biases like the illusion of validity is a key part of managing that risk. To summarize, the illusion of validity is a pervasive cognitive trap that can lead to costly financial errors. We are all susceptible to overconfidence in our predictions, driven by a host of underlying psychological biases. However, by understanding this illusion and consciously implementing strategies like systematic decision-making, focusing on controllables, diversifying, and fostering intellectual humility, we can navigate the financial world more wisely. True financial success does not come from trying to predict the unpredictable with perfect accuracy. It comes from making sound, reasoned decisions based on a solid process and a deep understanding of ourselves as investors. So my challenge to you this week is to reflect on a recent financial decision you made. Was there an element of the illusion of validity at play? Were you perhaps more confident than the evidence warranted? Consider choosing one strategy we discussed today. Maybe it is starting a decision journal, or consciously seeking out an opposing viewpoint before your next investment. Commit to trying it. Napoleon Hill said that belief is a defined goal supported by the conviction that it will be achieved. Let your conviction be in your process and your ability to learn, rather than in the infallibility of your predictions. Imagine a future where your financial decisions are driven not by overconfident guesses or emotional impulses, but by calm, methodical thinking and a humble awareness of what you can and cannot know. That future is within your reach. Thanks for listening. If you found this content valuable, don't forget to hit like and subscribe to the channel. See you in the next episode. Have an amazing day filled with positive energy.